British American Tobacco has been hammered this year, down 20% year to date. And what we want to understand in today's episode is, can we lock in this very undervalued price of $32 for BTI, lock in that yield at 8.41% and see our yield on cost grow and grow year on year into double digits alongside some strong share price appreciation. We're going to take a look at the historical performance of BAT. We're then going to jump into their income statement, look at their revenue growth year on year, also take a look at that bottom line, that net income, to see how that has performed. As always, we are going to look at the health of their balance sheet, take a look at their total cash versus their total debt. This is going to then tie into that dividend safety, some very important financial metrics for British American Tobacco. And as always, we're going to run it through our stock valuation model, getting to our intrinsic value and finding our acceptable buy price given our margin of safety. Now, it is down 20% year to date. It has been hammered and is down and lags the S&P 500, which is up around 16% year to date. It is right there at that 52-week low point. It does offer a very high yield of 8.41%, and we want to understand how undervalued is this and can we lock in this rate, which will only get higher and higher year on year. Shareholders, though, who have been holding the company over the last 10 years would be down around 39% without dividends reinvested, but is now a great opportunity to see the share price rise as well as that yield. Is it a win-win for potential investors or for investors who already hold a position and want to add more? Now, revenues, typically we like to see 3 to 7% growth year on year. December 2018, they reported 31.2 billion. December 2022, 33.4 billion. So it has increased over the last 5 years. However, when we take a deeper look, we can actually see that from 2020, it has in fact decreased. So we want to understand this when we look at our financial metrics shortly. But in terms of the bottom line, the net income is their growth. Well, December 2018, 7.7 billion reported on the bottom line. December 22, 8.1 billion. So again, growth over the last 5 years. But it tells a very similar story to the revenue. As we can see, it's increased. However, 2018 to 2019, we see the drop. And then from there, we see it go up and then down in 2022. So slightly inconsistent in relation to that total revenue. But let's take a look deeper in our financial metrics shortly. Balance sheet, I personally quite like to see a strong, healthy balance sheet. So when we look at the cash versus total debt, what we see here, December 2018, total cash and short-term investments, 3.5 billion. Very positively, their latest quarterly report released a few weeks ago, an increase to 5.2 billion. So a nice increase on that cash on the balance sheet. How does that compare to the total debt that they hold on that balance sheet? Well, total debt, 2018, 60.6 billion, so quite a significant amount. And very positive to see the latest quarterly report, 53.6 billion. So they have been paying off that debt over the last 5 years, which is positive. We're seeing the cash go up with the total debt coming down. So that should be very good news. How much of a good news? Let's find out. Dividend safety straight away, 45. It is borderline safe. Let's find out why. Market cap, 72 billion. So it is a large cap company. Now, key metrics for those that believe we're heading into a recession, and straight off, very positive for those who are looking to invest or investors. Recession dividend, they increased the dividend over the last recession period, 07-09. They had positive 4.8 recession sales. The reason why I'm saying that with such oomph is because if you've seen the videos, a lot of them are negative during the last recession, and this is above the average growth, which was in fact negative for the majority of the companies in the S&P 500. On top of that, even though we're seeing negative 31% return here, it did beat the S&P 500's negative 55% return from the same period. So very positive if you believe we are heading into a recession. Straight away, 23 years that they've been paying dividends, increasing year on year. What this means, they are 2 years away from having that dividend aristocrat status, which companies get when they've been paying increasing dividends over 25 years or more. Now, last full year, 1% increase. Last 5 years, 4%. And last 20 years, 10%. What I always say, Aim for at least 4%, as the US inflation rate was 4% over the last 40 years. Anything less in your salary, dividends, other income producing assets, you are taking a pay cut. So positive to see that the last 5 years was in line with inflation, especially when you're getting that above 8% yield, but slightly disappointing with that last full year. And it'll be interesting to see what the increase is in 2023. Now, dividend yield theory, for those that don't know, it states that a company is undervalued when the current yield sits above the 5-year average. So one sign of potential undervaluation here. However, we never look at any model in isolation and we'll draw conclusions towards the end of the video. Likewise, forward PE below the 5-year average, another sign of undervaluation. And we can see here the sector PE at 22.2 for consumer staples, with BAT at 7.6. As I mentioned before, and purely for information purposes, it is at the 52-week low. As I always say, 52-week low does not mean undervaluation, as well as 52-week high does not mean overvaluation. Now, free cash flow is what we always look at here, and for new investors, the reason why this is because the earnings is susceptible to manipulation by management through their accounting, and therefore, what we look at for the free cash flow, in my personal preference, is 60% below. Why? It means there is room to grow that double-digit dividend that we love to see, and it's one of the 7 golden dividend metrics that makes up for when I do my stock researching. And if you want to see the other 6, do check the pinned YouTube video. So below 60% is what I like to see, and from 2018 onwards, it has been below that 60%. So very good to see over the last 5 years. 2022, 50%, with 2023 expected to be 58%, which is around that 60% I look for. So very positive to see so far. Again, likewise, free cash flow per share, $1.95 in 2013, $4.32 in 2022. So it is increasing over the last 10 years. However, we are expecting a slight dip in 2023 to 4.07. So always, if you can, look at 10 years worth of data to give you a good idea of the way a company operates and their management. Sales growth, probably one area where they lag slightly to what I would ideally like, that 3 to 7% year-on-year steady moderate growth. What we can see, fairly cyclical, a few years of flat and negative, and then a few years of the double-digit increase. What this means numerically speaking, 15 billion worth of sales in 2013, 28 billion in 2022. So it is still increasing over the period, which is positive, but it would be good to see a more consistent increase year on year. That would probably be the one thing that I would love to see. Shares outstanding. Company, when they do share buybacks, they're returning excess cash to investors' pockets. So we always like to see this graph coming down. When it comes up, is the opposite. Your position as a shareholder is being diluted, and therefore it is a negative, as they do issue shares to fund growth projects and other operating. So 1.9 billion in 2013, 2.27 billion in 2022. So there are a large amount of share buybacks that have happened over certain years, as we can see 2016 to 2018. But other than that, it has remained relatively flat. And we can see there was a small amount bought back in 21 to 22. So do bear that in mind. ROIC, return on invested capital, another one of my 7 golden dividend metrics. 10% plus is what I like to look at, as it means management are able to effectively allocate their capital. Unfortunately, whilst it has been lower than that from 2018 onwards, it has been between that 8 to 9% range, which is still positive. I would like to see it creep up to 10, 11%, but I would say, given over the last 5 years, the 8 to 9% range is something that I can personally live with. Operating margin with tobacco companies, we typically see this, very strong margins between 36 to 45%, very positive. The consistency, likewise on the free cash flow margin, 20% plus, very, very strong, consistently above 20%. So very positive. Now, one area that I did have as a potential red flag looking at their balance sheet, that net debt to earnings for interest, tax, depreciation, amortization. This basically shows the number of years a company would take to pay off their debt net of cash on hand. Ideally, 3 and below is what I like to see. Positive is from 2017, it has started to come down. 2022, 2.96 years. 2023 expected 2.79. So positive, the fact that it is coming down, and now we are expecting to be well below that 3 that we look for. And on the right, purely information purposes, net debt to capital, showing that in 2022, 34% of the company's financing was from debt as opposed to equity. As always, if you are enjoying the video, do hit that like button, do subscribe to join the community. We have a ton of stock reviews in the pipeline that's coming out, and a ton that we have already done, so do go check them out. If you do want to grab a copy to run your own companies through the stock valuation model, do go check the pinned comment and do have a look at how yours would compare to ours. First model, Graham's valuation, earnings per share 375, growth rate per analyst estimates at 12, yield on AAA corporate bonds at 4.81. This gives an intrinsic value at $65.18. When we take a look at the graph, significant room for growth, nearly twice as much. In fact, it is 100% possibility there for growth when locking in that yield, showing that your yield on cost would be hitting double digits if it was to hit this price. So very, very strong so far. Then we move on to the multiples valuation model, companies in a similar sector and size. I'm sure you've heard of them all. Altria, Philip Morris, Universal. We have their stock price, earnings per share, giving us their P multiples. Average multiplied by the earnings per share, giving a BTI stock price of $50. Again, still showing significant upside to the current trading price and are well above that 52-week high. We then move on to the effective dividend discount model. Yearly dividends, we can see we've inputted here. Average growth rate at 2.23%. Now, I know a few of you will be looking and saying it's negative. However, they didn't do a dividend cut. Reason for this, British American Tobacco, a UK company, they pay out their dividends in sterling pound. However, this all relates to the movement on FX, which is why these increases will differ slightly to the actual increases that you'd see on their website. Forward looking, I've gone for around 2% to be on the more conservative side. However, I would expect it to be higher. If you do grab a copy, check the pinned comment. You can play around with what you expect, your own estimate and judgment, and see what that would come out as. This gives a DDM price of $45.76. Still room for growth and right there at that 52-week high point. Final model, the discounted cash flow model, year-on-year free cash flow, average growth rate nice at 12.4%. Analysts estimating a very small positive growth rate forward looking on the free cash flow. I've been again more conservative at keeping it flat. Using the discount rate, we have the present value of future free cash flows and terminal value. Adding those together, add the cash, subtract total debt, we get to our equity value. Divide by the shares outstanding at 2002, we get a DCF price of $68. Again, significant upside to that current trading price, showing that effectively the market hasn't caught on to the intrinsic value of BAT. Now we have the four models. As always, if you are enjoying the content, do hit the like button. It really helps the channel, and do subscribe to join the community and have these videos to your doorstep. Intrinsic value is essentially the average of the four models that we have just gone through. Current price at around $32.46. If you had a margin of safety, now always have a margin of safety in my opinion. Typically, wide moat, strong financial metrics, forward-looking data. I would say margin of safety of 10%, which would mean your acceptable buy would be 52. However, for BAT, I would be saying a margin of safety around 20 to 30%. 20% margin of safety is still a buy up to 46. 30% margin of safety of $40. So in my opinion, it is a screaming buy. Now, in terms of a margin of safety, if you wanted a large margin of safety, or if you wanted to see what the maximum margin of safety is for entering at the current price, well, look, around 40% margin of safety, your acceptable buy would be up to 34, which means it's still a buy, showing that if you were to enter at the current trading price, if we try it here, 45, you would be getting essentially between 40 to 45% margin of safety, locking in that high yield. Now, Wall Street forecasts the price over the next 12 months to hit around $49.87, again showing significant upside to that current trading price, and as we can see there, above that 52-week high, which they think it will blow through. As always, let me know your thoughts in the comments. Are you a shareholder or potential shareholder looking to add, even looking to sell, or purely on the sidelines speculating? Don't forget to like, subscribe, catch you on the next episode. As always, take care and have a great day.